In this video, I am not making a prediction. What I want to do is explain how market structure has been developing through time, focusing on session interaction and reference behavior rather than outcomes. This is a structure explanation, not an outcome call. To begin, it is important to understand where the current structure originated. On the 1-hour chart, the Asia session on the 23rd established a reference box that later sessions continued to interact with. This box functioned as a balance area rather than a directional launch point, and its role becomes clearer only when we observe how subsequent sessions behaved around it. Following that, the U.S. session on the 23rd established its own anchor with particular importance placed on the lower boundary of that session structure. This lower boundary did not resolve structure at the time. Instead, it remained available as a reference, meaning price did not decisively accept below it, nor reject away from it. When we move forward to the U.S. session on the 26th, the starting position of that session matters. Price did not open from below structure or from a new extreme. It began above the Asia session anchor from the 23rd, already inside a previously defined range. This starting location immediately limits what that session can resolve. A session that begins inside structure is positioned to test and interact, not to confirm direction. As the U.S. session developed, price rotated lower. This movement was not impulsive. It unfolded gradually, candle by candle, as price moved back toward the lower boundary of the U.S. session anchor from the 23rd. As price approached that lower boundary, momentum slowed rather than increased. There was no acceleration through the level. Instead, price spent time pressing into it, trading around it, and probing whether acceptance could form. This behavior is critical. Structure is not defined by whether price touches a level, but by how price behaves while it is there. In this case, the lower boundary of the prior U.S. session anchor was tested through time, not broken through momentum. By the end of this phase, structure had not resolved. Price had not established a new lower range, and it had not rejected decisively higher. It remained engaged with prior structure, setting the stage for how the next session would develop. The Asia session on the 26th did not immediately establish its anchor at the open. In the early part of the session, price remained close to the midpoint of the prior U.S. session range, spending time moving back and forth rather than extending in either direction. During this initial phase, price showed hesitation. There was no attempt to push beyond the upper boundary of the U.S. session anchor, and there was no sustained pressure to break below it either. This lack of early initiative already framed the session as one of interaction rather than resolution. As the Asia session progressed into its middle phase, the anchor began to form from the midpoint into the upper portion of the same day's U.S. session anchor. This development did not occur in a single step. Price repeatedly returned to the same internal references, reinforcing that the session was building value inside existing structure rather than attempting to create a new range. What is important here is not only where the Asia session anchor formed, but how it formed. Price did not accelerate into its final anchor position. It arrived there gradually, through repeated rotations and pauses, each time failing to establish momentum away from the prior U.S. session structure. As the session moved into its later phase, price once again revisited the U.S. session anchor from the 23rd. This was not the first interaction with that level, and it was not the last. The repeated return to the same reference tells us that the market continues to rely on it as an active structural boundary. Each revisit added time, not resolution. Price traded around the level rather than rejecting it or accepting beyond it. This repeated testing through time is a clear signal of unresolved structure. During this entire sequence, the 1-hour 120 moving average continued to change character. Earlier in the move, the slope of this average was more pronounced. As price rotated and revisited the same references, the slope gradually became more shallow. This flattening was not a reaction to a single candle or event. It developed as a consequence of time spent inside overlapping structure. A flattening moving average reflects deceleration, where directional pressure weakens and interaction dominates. By the end of the Asia session, structure had not transitioned. It had layered. Session anchors, prior U.S. references, and the flattening moving average all occupied the same zone, reinforcing the idea that structure remains in negotiation rather than resolution. Volatility behavior provides additional insight into this negotiation phase. On the 1-hour chart, the long-term Bollinger Bands began to open during this period, but the expansion was uneven. The upper band expanded at a noticeably steeper angle than the lower band. This imbalance matters. It indicates that volatility is increasing in a directional sense, but without the symmetry that typically accompanies structural confirmation. At the same time, the lower band lagged behind, showing that downside volatility was not expanding at the same rate. This divergence between the two sides of the volatility envelope suggests pressure without acceptance. While the long-term Bollinger Bands were opening, the short-term Bollinger Bands on the 1-hour chart were doing the opposite. They began to contract. Immediate volatility decreased as price spent more time rotating within the same structural zone. This combination is significant. Longer-term volatility adjusting upward while short-term volatility compresses often appears when the market is pausing rather than transitioning. Price is not resolving structure. It is recalibrating inside it. When we move down to the 15-minute chart, this theme becomes even clearer. The long-term Bollinger Bands on this time frame are not expanding aggressively. They are moving sideways with a very slight upward bias, reflecting controlled drift rather than trend development. This slight upward bias did not accelerate. Price remained confined with an overlapping session structure, repeatedly returning to familiar references rather than extending away from them. During this same period, a moving average golden cross occurred on the 15-minute chart. However, this crossover did not appear in an environment of expansion. It formed while volatility was compressed and while the 120 moving average was beginning to flatten. The context of this crossover matters more than the crossover itself. When such events occurred during compression, they reflect participation within a range, not structural resolution. Across both the 1-hour and 15-minute charts, the message remains consistent. Volatility is changing shape, moving averages are flattening, and price continues to rotate through overlapping session anchors. Structure has not resolved. It has become more layered. In this environment, single events do not carry decisive weight. What matters is how long price continues to interact with the same references, and how volatility behaves while it does so. As long as this interaction persists, conclusions remain premature. Waiting here is not passive. It is structurally valid.